printing money. That's the definition of inflation. And what's going to happen is the dollar's going to fall through the floor. Asset prices are still going to fall, but consumer good prices, prices that Americans pay when they go to the supermarket, they're going to go through the roof.
All right, Peter, our round table. We've got Cantor Fitzgerald's Mark Pato, and with a fixed income perspective is Barclays, Jack Malvi, and Euro Pacific Capital's Peter Schiff. Now, of course, equity markets have not been the only markets that have been on the move. We've had gold, the dollar, also oil making a lot of very dramatic movements. I want to start off with gold, though, because I know, Peter, being that you're a bear in equities, you're a bull on gold. Some might say, though, that it's not going to last, particularly with some of the deflation concerns.
Well, look, we've been in a bull market in gold since 2000. We've been in a bear market in stocks since the same year. And I think in this recent correction in the price of gold, what's amazing about gold is how well it's held up relative to other commodities, relative to other currencies. You know, gold's now at a record high against the Australian dollar, the Canadian dollar, the South African rand. Gold's, gone up dramatically against oil, against industrial metals, against agricultural commodities. So I think there's been a stealth run in gold over the past few months, except when you're looking at it through the prism of the dollar, you don't see it. But this dollar rally that we've had is phony. The next major move in the dollar is going to be a collapse.
Why do you say it's phony?
Well, because I think it's just due to deleveraging. Americans are having to sell everything they own to pay off their debt, and they're selling assets at fire sale prices. They're moving into the dollar. But that's not going to last. Everything that we are doing right now is so fundamentally destructive of the value of the dollar. And I think it's going to be a crisis. The dollar is going to drop like a stone.
Jack, you think the dollar is headed lower, despite the rally we've seen on deleveraging?
In the near term, probably gets a little bit stronger because we're not just alone in terms of having tough times. There are tough times in Europe. There are tough times coming in Asia. So in some ways, it's tough currency except for all the rest. So it's a year from now. I wouldn't be surprised if the dollar is a little bit stronger than it is today.
Yeah. But you got to look at the difference between why we have tough times and why they do. We have tough times because we're broke. Their tough times are because they loaned us money and we can't pay it back. But fundamentally, the creditor economies are in much better shape. They have sound economies. They can absorb these losses. We're broke. And when the world cuts us off, we have a major economic collapse coming because our phony service sector economy won't function anymore without foreigners lending us money and supplying us with goods.
Well, Europe hasn't really lent us that much. Parts of the Middle East, as you know, are really having a tough time right now as well. So
well, our biggest creditors are in Asia, of course, in China and Japan and Southeast Asia. But that's going to stop.
Well, Japan is in recession now, too.
Well, Japan is in much better shape than the United States. They're the world's biggest creditor. They have a balance of trade surplus. They have a high savings rate in Japan. Japan's in great shape. We're a mess. We're a complete disaster.
Not in the same camp.
Well, I mean, that's why I was able to predict everything that's happened for the last year or two. I don't know what you were forecasting a couple of years ago.
Mark,
well,
jump in.
The dollar actually has been in a decline for the last 6.5 years. The dollar index falling. And I think that was a concerted effort by the administration to devalue the currency to get us on a level playing field with a lot of our foreign competitors so we could bring manufacturing back. So I do think that we're going to probably go down and test those lows on the dollar index around 72. I don't know if I want to call it a collapse. That's the only problem. I don't want to go down the road of calling for disaster and an implosion of the capitalist system just to prove a point.
Not the capitalist system.
Be weaker.
We're not very capitalist anymore. We're more socialist. But I think the dollar index is going to hit 40 and potentially maybe even as low as 20.
Mark.
Okay. Yeah. See, I wouldn't go that far to say that.
Well, I wouldn't. I just did.
Okay, let's get beyond that. But Mark, in terms of the dollar, of course, we talk a lot about that in relation to the commodities. In terms of energy shares and oil prices, I mean, do you see how's the dollar going to affect oil going forward? Because we've seen a big drop already.
Well, as I said, I think that once we get past the end of the calendar year, I think there's a lot of pressure on the calendar year right now, pushing up the dollar, pushing down the price of crude, as a lot of these funds, these hedge funds, look to liquidate what they can, especially what's liquid, hitting oil, hitting gold. So we're going to see a rebound in gold and oil and a depreciation of the dollar in the first quarter. So I think that there's a very playable trade on a short-term basis right there. So the end of this month, I think, is going to be an opportunity, and 2 weeks before the end of December.
Okay, Peter, Mark, hang on, and also roundtable, Mark Pato, U.S. market strategist at Cantor Fitzgerald, Jack Malvey, fixed income strategist at Barclays, and Peter Schiff, oversees $1 billion as president of Euro Pacific Capital. Jack, let me start with you this time. Getting back to the bond markets and treasuries, of course, we've seen a whole lot of buying. Some would say that the market there, treasuries are now overbought. I know Peter thinks that they're in a bubble. What is your view on this?
They're very rich as an asset class. I think that we've got more easing from the Fed likely on December 16th and again in early 2009. This flight to safety, capital preservation trade likely will drive medium and long end yields a bit lower than where we are today still over the course of the next several months. But if you look out a year or two, the combination of tremendous supply and hopefully economic and capital market normalization will drive these yields back up higher. I think strategically the bond asset class is really not a place for a great overweight.
Right, you wouldn't be buying into that. Peter, you agree with
I agree, but I think there's a lot more risk. We've had a bull market in bonds, since 1980. It's now in the manic stage, I think when this bubble bursts, we're going to take out the lows in the bond market from the 1970s. It is going to be a bloodbath in bonds. And not only that, not only are bonds going to plunge, but the dollars in which they're denominated with are going to plunge too. So people are going to get wiped out in treasuries. They're going to lose almost all their money. Or their purchasing power.
Yeah, and obviously, bond markets being very affected by what the Treasury is doing. We've been talking about the economy, and also about the Fed. Jack was just talking about where he sees Fed rates going. Mark, I want to bring you back into this conversation because if the Fed continues to cut rates, and Jack just saying that very likely to, is that going to help restore some more confidence in the markets, or will it do nothing?
I think that in terms of the markets, it's not going to be the one thing that's going to restore confidence. There's got to be a lot more that's going to come into play, and cutting rates here is only creating a wider spread for those that are borrowing against it, borrowing at the Fed window. So the idea is to try to help bring that money in, get liquidation in there, but ultimately I agree with both Jack and Peter that we're going to see higher rates, and the 10-year probably closer to 6 or 7%. Hopefully not the disaster that Peter's calling for.
Well, the big problem is, right now the Treasury is benefiting.
But in that direction, okay? We're going in that direction.
The Treasury is benefiting because everybody is focusing on default risk, and nobody believes that the Treasury would default, and so everybody is buying Treasuries as opposed to corporates or anything else. But the real risk isn't default. The real risk is that they pay you back, but they do it with a printing press. They give you money that has no value, and that's what's going to happen.
And that's going to spur the hyperinflation scenario you're talking about.
Our bonds are rated AAA. They're junk bonds. They're as AAA as the subprime mortgages were. Stay away from them. Okay,
I want to get to back to the equities because we were talking ahead of the break about where's the bottom. Mark, I want to get back to you because you're the equity strategist. Where do you see a bottom in this market?
Like I started to say, I don't think that it's a matter of